Hi there. In the third installment of our discussion of the cost of capital, I discussed the cost of debt. In this part one of a series on debt, I want to return to the topic of corporate debt. Unlike before, however, I shan't be concerned necessarily with the cost of debt, but more with definitional issues. In part two, I shall discuss sovereign debt, that is, the debt of nations. In that episode, I shall focus more on broader issues around sovereign debt, and then in subsequent episodes, I shall home in on specific aspects. For instance, which nations are most indebted and why? Which nations or institutions are the biggest lenders? What are the social, fiscal, and political implications of debt, project finance, including public-private partnerships, and so on? And now on to today's discussion. In corporate finance, many different names are thrown around for what is essentially the same thing, debt. But clearly each name connotes a different flavor of debt. You may sometimes be looking at the plain vanilla, or at other times something a bit more exotic and nuanced. So, what is debt? The answer to this question may seem obvious since the balance sheet for a firm shows the outstanding liabilities of a firm. This is what I shall be discussing today. Before I continue, however, do visit our website where I curate news and publications from international financial organizations and world central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. There are items of the balance sheet that create fixed commitments for the firm and provide the same tax deductions that interest payments on debt do. The most prominent of these off-balance sheet items are operating leases. Consider what an operating lease involves. A retail firm leases a store space for 12 years and enters into a lease agreement with the owner of the space, agreeing to pay a fixed amount each year for that period. I do not see much difference between this commitment and borrowing money from a bank and agreeing to pay off the bank loan over 12 years in equal annual installments. For all intents and purposes, therefore, operating leases are debt. Converting operating lease expenses into a debt equivalent is straightforward. The operating lease commitments in future years should be discounted back at a rate that reflects their status as unsecured and risky debt. As an approximation, using the firm's current pre-tax cost of borrowing as the discount rate yields a good estimate of the value of operating leases. Another form of off-balance sheet financing is the special purpose vehicle or entity, that is SPV or SPE. An SPV or SPE is a company that is created especially for the purpose of financing another. The idea is to protect the capital structure of the company being financed by not putting the debt and/or equity on its balance sheet. SPVs are especially useful for parties that are capital deficient to be able to undertake large-scale acquisitions or buy-ins. The next form of debt to consider is the bond. Bonds are a form of medium and long-term securities. Bonds may be issued on a fixed-rate basis or a floating rate. Bonds mean borrowing from the capital markets and dealing directly without the intervention of a bank. A bond is a form of security, which means that it is transferable. A firm can issue a bond either in its home country or a foreign bond in another country. For instance, a Yankee bond in the US or a samurai bond in Japan, or an international bond like the Eurobond. Foreign or international bonds enable corporations in especially smaller countries to be able to raise large amounts of debt that they can't raise in their own home countries. Some key features of a bond include a trust deed, a trustee institution, interest, ranking in terms of the company's other debt, repayment provisions, and so on. Bonds and other loans frequently also have debt covenants. These are provisions that lenders require to be included in the terms of the debt that require the borrower to maintain the company's affairs, especially financial, in a particular state. For example, there may be a requirement that the company maintain a set of financial ratios at certain levels or ranges. The purpose of debt covenants is to protect the lenders as much as possible against the possibility of default or negligence on the part of management. Some bonds are convertible. Unlike the common or garden bond, a convertible bond can change its spots. A convertible security may start life as a debt or hybrid instrument, but later be converted into common stock. You can think of a convertible bond as equivalent to a normal bond plus a call option to acquire common stock in the company. Bonds can be valued as the present value of the regular interest payments and the final principal payments, discounted at a rate that reflects the risk of default. The level of the interest payments is fixed on issue, and therefore an investor is buying the right to receive a set of regular coupon or interest payments together with the final return of the principal. Bonds can be analyzed based on risk and return like other investments. Since risk factors can change during the investment period, so investors need to make decisions on whether to hold, reduce, or increase the bond investment. There are several classes of risk to consider. These include changes in interest rates, reinvestment risk on the coupons and principal, yield curve risk, prepayments and call risk, credit risk defined as default and downgrading, liquidity, exchange rates, inflation, macro and external risk. Ratings agencies help investors by grading bonds according to their credit risk profile. They also provide regular updates of bond risks and whether bonds are upgraded or downgraded. Staff at the Federal Reserve Bank of New York have created an index aimed at tracking dislocations in the primary and secondary corporate bond markets. They describe it this way. We introduce the Corporate Bond Market Distress Index, CMDI, a unified measure that quantifies joint dislocations in the primary and secondary corporate bond markets. While there are a variety of measures for capturing aspects of corporate bond market functioning, there has been little consensus on how to use those measures to identify periods of widespread distress in the market and on how to weight different measures. The index incorporates a wide range of indicators, including measures of primary market issuance and pricing, secondary market pricing and liquidity conditions, and the relative pricing between traded and non-traded bonds. We update the CMDI estimates and brief commentary at 10 a.m. on the last Wednesday of each month. The next form of debt to consider are asset-backed securities. Instead of borrowing money directly, Companies sometimes bundle up a group of assets and then sell the cash flows from these assets. One class of asset-backed securities, mortgage-backed securities, or MBS for short, were principally responsible for the great financial crisis of 2008. Without getting into the complicated financial intricacies, a good way to understand what happened is ably depicted in an entertaining way in the movie The Big Short, starring an all-star cast. During COVID-19 induced disruptions to financial markets, the Fed's Federal Open Market Committee intervened heavily to ensure a smooth functioning of the secondary MBS market. Of course, not all debt is issued publicly. Many companies raise debt through private placements with a few institutions. This debt, however, would most likely carry similar terms and conditions as publicly issued debt, except that there may be flexibility to renegotiate matters as corporate or market conditions change. Project finance, on the other hand, is non-recourse financing. It involves the creation of a separate entity for a project that can stand apart from the business of the sponsor. The brief could be to design, construct, and operate, for example, a power station for a utility. Generally, the future cash flows can be forecast and used as security for the project financing. The objectives are to establish a vehicle to receive capital in the form of equity and debt, expend the funds on constructing assets, generate a revenue stream to pay back the loans, and provide an acceptable return to the equity participants and demonstrate the security in the project to the lenders. The difference between project finance and a traditional loan is that the former depends on the ability of the project to generate sufficient funds for loan repayment. In a traditional loan, the borrower is responsible for repayment, whereas the project vehicle is ring-fenced from other assets of the sponsor. Financial engineering and structuring seek to allocate the potential gains and losses between the parties. Funders need to carefully examine the sources of risk, since there is no diversification of risk, as there would be when a company undertakes a range of projects. In addition, projects are typically sizable and perhaps too large for one participant to accept all the risk. While a company seeking a loan can show the lenders an operating history and annual reports, a project plan can only point to future profitability and cash flows. Project financing arrangements usually include mutual interests in structuring over and above separate financing for allocating risk and reward. Advantages include pooling of benefits between interested parties, means of spreading risk among specialists in particular fields, for example, financiers, constructors, and operators. A fixed life arrangement releasing excess cash flow to equity participants after debt servicing has been covered, which could allow higher returns than from traditional financing. The project vehicle manages the cash flows to lenders, equity participants, and sponsors to ensure that debt providers are paid directly from the project flows without recourse to a standalone company. Increased debt capacity and increased gearing are possible because the debt is supported not just by the project's assets, but also by a variety of contracts and guarantees provided by customers, suppliers, and so on. Lower cost of capital than traditional finance due to increased leverage and risk premiums. Contractual arrangements for resolving disputes and potentially lower legal costs. I shall return to the discussion on project finance when I discuss sovereign debt.